Today's guest is one of the most respected voices in fundamental investing, but he didn't start as an expert.
I graduated from college in 2004. I considered myself to be financially illiterate.
Despite a business degree, he entered the market with almost no real financial education.
The only thing that I knew how to do was look up the price of a stock. If you were like, is this stock a buy? I would be like, well, it's $7 a share. End of due diligence.
He learned investing the hard way by losing his own money.
I was effectively putting money into a cash-burning machine because I was buying garbage businesses I didn't understand.
That pain turned into a 20-year journey studying the world's best investors.
And there's nothing like losing your own money rapidly to make you want to learn more about it.
In this episode, we break down how to actually evaluate businesses.
The way that you should value a company should depend heavily based on where that company is in its life cycle.
Why most investors fail, and how to build conviction when markets turn against you.
Conviction is essential before you make any investment. 3 things to look at. 1 would be revenue, the 2nd would be operating profit, and the 3rd would be
Brian Feroldi. So welcome to the pod.
Thanks for having me, Gav. It's a pleasure to be here.
Love it. So I want to start with a little bit of background on yourself because, everybody has the things that shape them, right? Their story, their experiences. And at this point, most people that have followed you, they've only known you as a social media content creator, right? But there's a background that shaped you to get to this point. Could you give people a little bit of insights as to what that was?
Sure. So I graduated from college in 2004, a 4-year degree in business. Despite getting what I would feel would be a perfectly fine education, I considered myself to be financially illiterate after graduating from college. And that was despite studying business. Yes, I knew a little bit about business law and the theory of marketing and the theory of accounting, but so many of the absolute basics to personal finance were where I was not taught at all. The concepts like how the stock market works, what compounding is, the difference between saving and investing, difference between a 401k and a Roth IRA, like all these basic personal finance principles. Now, my dad gave me a copy of Rich Dad, Poor Dad in 2004, very popular book at the time, and I just devoured that book in like a weekend. Looking back, there's many principles in that book I disagree with today, but it was the first time that anybody ever explained to me how rich people think differently than the middle class and poor people do, how rich people think differently about housing, how you can purchase income, how you should go focus on growing your assets and investing both in yourself and in capital. The idea of leverage and borrowing money and studying people like Warren Buffett. It was actually through Robert Kiyosaki the first time I ever heard the name Warren Buffett.
Interesting.
That kick-started a love affair that essentially continues to this day with all things related to money, personal finance. And I discovered over time that the asset class that best matched my personality was the stock market.
That's super interesting. And that's cool that Robert Kiyosaki was that intro into Warren Buffett, right? Because there are, similarities between them, but also large differences in terms of kind of the doom calling and some of the other things that you see from them nowadays. So I want to dig a little bit deeper there into this understanding of businesses and the love and the passion that you had for it. What made that love so deep, when you think about it? Like, what was the thing where it just clicked and it was like, these are a couple of the moments that made me feel like this is what I'm going to do?
So when I first started, I'll put this in air quotes, investing, it was in 2004. As I said, I had zero financial education or very limited financial education. The only thing that I knew how to do was look up the price of a stock. If you were like, is this stock a buy? I would be like, well, it's $7 a share. End of due diligence, right? I couldn't tell you about the market cap. I couldn't tell you about the management team. Couldn't tell you about the products. Couldn't tell you how to even find the information that you would need, let alone analyze the information. So with that limited education, I went out there and I started buying and selling stocks. And predictably, you can probably imagine what my results were. Horrible, right? I was effectively putting money into a cash-burning machine because I was buying garbage businesses I didn't understand. I didn't understand the psychological effects of investing, and I thought it was you try and buy a stock for $1.50 and sell it a week later at $1.75. That's what I thought investing was. Now, thankfully, I consider that to basically be the best tuition I've ever paid because while the dollar losses that I experienced in absolute terms were fairly minimal, they were pretty big to me at the time. And there's nothing like losing your own money rapidly to make you want to learn more about it. So I started with penny stock investing. I moved on to high dividend yield investing, and that caused me to start to pay attention to fundamental investors like Warren Buffett, like Charlie Munger, like Peter Lynch, like the Gardner brothers. And slowly after studying them that I realized, I'm a full quote unquote fundamental investor. At least these investors that I held in high regard were fundamental investors. And that's when I started to study that subject more seriously.
Perfect. I'm glad you mentioned the word there, fundamental. So let's break down, what does fundamental analysis mean just in plain English terms?
So there's lots of different ways that you can analyze a business. If you're a short-term trader, fundamental analysis is effectively useless to you. It's really studying the core numbers that drive a business. What are its products? What are its services? What are its revenue? What are its margins? What's its balance sheet like? What's its cash flow like? What are its returns on capital? These numbers are immensely important if you're going to be buying a business or buying a business as an investor to hold for a multi-year period. These numbers are utterly useless to you if you're a trader. If you're a trader, the things you need to focus on are technical analysis, sentiment analysis, the news of the day, where you think the prices are going to be heading over the next, 1 week, 1 month, or 3 months. And that's why if you are a fundamental investor, knowing technical analysis or being an expert at following the news isn't really that useful to you. So the way that you approach a stock and really the time frame that you plan on holding that stock, holding that investment, dictates heavily whether you should pay attention to technical analysis or fundamental analysis.
Do you think that there's any crossover between the two, where somebody that is looking to buy something long-term based on the fundamentals might try to line up the timing of their additions to that stock with some technicals, or vice versa?
Absolutely. Yeah, if you were to ask me that question 2 or 3 years ago, I would have said no. I thought that technical analysis was voodoo. I've since learned enough about it to have at least a belief that technical analysis can assist with two things. The first thing that technical analysis can assist with is measuring the mood of the market, measuring the mood and the sentiment around a stock. When it was explained to me from that angle, I was like, oh, okay, I now understand how technical analysis can have some usefulness to it. The second way is that I think it can help you with timing your entry points. For example, I've just observed through investing for 20 years that momentum is a real thing. Whether you want to admit it or not, it is absolutely a real thing. As a general statement, stocks that have gone up a lot tend to keep going up a lot, and stocks that have gone down a lot tend to keep going down a lot. The old me would have looked at a company that I liked falling and just said, well, the valuation now is compelling, and I would have liked to say buy that stock. But I bought plenty of stocks that I thought were a good valuation, but the momentum was against you, only to watch those stocks get cheaper. So now I think it does make sense to layer in a little bit of technical analysis to help you figure out when is a good time to enter into a stock so that you can make more timely buys for your portfolio, even if you're a fundamental investor.
The key word that I pull out from what you just said is cheaper. So there's cheaper, expensive, but how do we actually define what these things mean when it comes to stocks is really my question. So there's a lot of metrics, right? You can go onto a platform like Seeking Alpha and they'll show you, 50 metrics within the fundamental analysis spectrum. But what are the few metrics, or maybe the several metrics, that you pay the most close attention to decide, is this cheap, is this expensive, is it properly priced?
Really key thing that I've learned about valuation, which is a very complex and hard study to think about, is the way that you should value a company should depend heavily based on where that company is in its life cycle. For example, if you were to look at a 1-year-old baby and you were to say, how is this baby's development? You would ask questions like, is it walking? Is it talking? Can it feed itself? Does it sleep through the night? These are fundamental things that you would analyze based on an age of a baby. Similarly, you wouldn't look at a 25-year-old and say, wow, this 25-year-old's walking. It can talk. It can go to bed and wake up. You have to change the metrics that's used to analyze a human based on how old it is or what age of development that it is. That same concept needs to apply to stocks. This is something that is mind-blowing to me when I figured it out. If a company is in its early infancy, if it's pre-revenue, or if it's in the hyper-growth revenue phase, you need to analyze it and value it using different metrics than you do for a company that's in the capital return phase. So, simpler, if you're looking at Rivian's stock, You don't look at its price to earnings ratio. You don't look at its price to cash flow ratio. You look at its total addressable market and its revenue growth. Those are the appropriate valuation factors, or at least the metrics to look at to determine if it's a good value or not. Conversely, if you're looking at Coca-Cola or IBM or Procter & Gamble, you need to look at its price to earnings ratio. You need to look at its dividend yield. You need to look at its return on capital and its free cash flow conversion ratio. Those metrics become useful because the company is in a later stage of its development life cycle. So when you ask what valuation metric do you look at, the first thing you need to figure out is which phase of the business growth cycle is this company currently in? And then once you've answered that, can you pick the right metric?
Do you think that life cycle is largely based off of time, or what are some of the other factors that you look at to say, where is this company in its life cycle?
It's usually based off of time, but companies grow and die at different speeds. AI companies these days, are growing at lightning fast speed when compared to, say, a consumer brand or an upstart clothing company. So different industries do grow at different speeds, and I would say, as a general statement, the faster a company grows, the faster it is to die, and the inverse is also true. But the way that you figure out, the easiest way to figure out what stage a company is in is by looking at its operating profit. That's a mid-tier number down the company's income statement after subtracting all costs, but before income and taxes come into it. If a company is losing money and those losses are getting bigger every year, it's very early in its development, and it's dependent on outside capital to keep itself going. So it needs to sell stock, it needs to sell debt, it needs to do something to fund the losses that it's having. If a company is at break even on an operating profit basis, then it's reached the break-even analysis. And if that operating profit is growing, and even better, growing faster than revenue, then it could be in the operating leverage or the capital return phase. So there's a couple of numbers that you need to look at to figure out which stage that it's in. But if you had to pick one to look at, to me, it would be operating profit and the operating profit trend.
And it seems like that's because operating profit accounts for, or doesn't account for, some of the other things that might be happening, right? Well, maybe a company is putting a ton of money into research and development or something like that, right? So it kind of is a better metric than just looking maybe at bottom line, what the actual profit was.
Correct. So revenue is a great number to look at. That's fairly clean. But what a company does with its revenue, how much a company is spending in proportion to its revenue, tells you, is the company focused on growth? Is the company focused on profit? Is the company focused on break even? So that number, more than any other, can kind of help you with the stage that a company is in. So if you could choose, three things to look at, one would be revenue, the second would be operating profit, and the third would be capital return, which is either a dividend or a buyback program. Those three numbers can really tell you where the company is in its growth development phase.
How many companies do you think the average person should be realistically maintaining in a portfolio, understanding that, hey, you want to stay on top of these metrics and you can only do this for so many companies?
Yep, that depends very much on how much time and interest the person has in managing that portfolio, and it also depends on the riskiness of the portfolio. If you're the type of investor that's looking at a lot of stage 1, stage 2 companies, so hyper growth companies that are losing lots of money, I'm a believer that you need to diversify greatly across those companies because the failure rate is so high in those businesses. But if you can find the next Salesforce.com, the next Amazon, the next Tesla early, all you need is one or two mega winners and they'll pay for all of the losers combined. So if you're an early stage investor, diversify. You probably should have dozens of companies in your portfolio if you're largely going after that stage. If you're a late stage investor, you're going after big, established, wide moat companies that crank out profits, that are paying a dividend to your paying a dividend, such as the Microsofts of the world, the Googles of the world, the Amazons of the world. I think you could take a far more concentrated position in that company and narrow your universe to an analyzable number of businesses. So if the later in the stage that you're going for, I do think that concentrating your portfolio and limiting the number can make sense. To say, let's say you follow 30 companies and maybe you own between 10 and 20 of them. That roughly makes sense to me. If you're going at the earlier stage and you should be diversifying, you should probably follow more and own more of those businesses.
Where does something like Tesla and Nvidia fall into that range?
So Nvidia is definitely in stage 5, although it has many characteristics to me of a stage 4 company. great. I mean, these are truly outstanding, exceptional businesses. Nvidia, in particular, because it's been returning capital to shareholders for years, but the growth numbers this company is putting up almost indicates that it's back in the hypergrowth phase. So Nvidia has been a rare unicorn jewel that is a company that is ridiculously profitable and growing ridiculously fast. That is an extremely rare combination. But to me, it's very much in the capital return phase of its growth cycle. Tesla is probably the hardest company in public markets to analyze, period. Not only is it very controversial, but even if you're digging into its financial statements, it's hard to classify as a business. It is generating cash. It is cash flow positive and has been for years, but the company's revenue growth has been anemic for the last couple of years. If you dive into the details of it, you do realize that the energy business is growing, the services business is growing, but the auto section of the business, which is 85% of revenue, sales there have actually been declining over the last couple of years as the company gives more and more price concessions to its consumers. So Tesla is a very hard business to classify, but if you force me to choose, I would say it's in the operating leverage phase. Although the company has been going backwards and forwards, you can go in both directions on the business growth cycle, and Tesla has certainly been doing that.
It's bringing up a bigger question. Tesla and Nvidia both play in this area of AI, and people are kind of trying to project out what's going to happen in the future, right? And it makes it a little bit more difficult for these companies where you look at the current revenue growth, right? And you say it's weak, but then people make the case for, an optimist in the case of Tesla. But not just Tesla specific, a lot of companies right now are trying to figure out what is the future going to look like and how does this company fit into it? So how do you think about that as a fundamental investor saying, the numbers don't reflect this right now. There's maybe an industry that's happening, and maybe right now it's AI. It could be something else later on, right? Originally, it was the internet. How do you wrap your head around that as a fundamental investor?
Yep. So again, Tesla is an extremely hard company to analyze if you're an investor, period. Because as you just pointed out, the company has multiple business segments, and those business segments are at different points of the business growth cycle. So the auto business that it has should be in the phase 5 capital return phase, but the company is effectively taking all the profits that it makes from that business and it's redeploying them into the AI ventures, into Optimus, and into other segments of the business, which you should say is absolutely the right move to make given the potential that Elon sees long term for the business. The storage business, the energy business, that was money losing for quite some time. Now it's become actually a more not mature business, but it's to the point where it's generating operating profit, or at least very close to it. So that business was started
right
6-7 years ago, something like that, and now it is and now it has moved successfully along that. Well, if you look at the Optimus business, that's clearly purely a startup. If you look at the Autopilot, the full self-driving, the robo-taxi businesses, those are clearly very much in the startup phase. The company also says that it has its own internal chip development program. That's in the startup phase. So Tesla itself, you have to take a look at both the entire company level and the individual segment levels and assign different values to them. That is, again, why valuing a company like Tesla is so stinking hard. And if you were to just look at the company's price to earnings ratio, price to free cash flow ratio, even price to sales ratio, you've been confused for the last 15 years because the number probably doesn't make sense in relation to what the market's been paying for it.
I think people listening to this might hear this and go, wow, like there's a lot of work to be done here, right? You have to break down the company by segments. You have to go through these numbers, but this is what you do. Like, you help make this simple for people. So I think you do it through a lot of the graphics that you put together, the resources. Can you just talk to like how you've kind of solved that problem of people look at this and they realize, hey, if I want to be a great investor, I actually have to do work, right? And I actually have to have systems and processes. And how did you go build out those systems and processes for millions of people to be able to do this?
School of hard knocks on that one, right? Whenever I would buy a stock and learn a lesson the hard way because I was ignorant of some risk or I was ignorant of some metric and I would lose money on, I would kind of file that away in my brain as, oh, that's a really important nuance that I need to think about in the future. Real simple case study here. Rewind the clock 5 or 6 years, I was a big investor in Grubhub. Do you remember Grubhub?
I do.
Grubhub was the market leader in many segments in food delivery. At the time, I believed that Grubhub had a very durable competitive advantage in its markets because I thought the largest, it was a marketplace business. So the company with the most consumers and most restaurants was going to be a long-term winner. That thesis proved to be dead wrong because along came DoorDash, and DoorDash just blew Grubhub out of the water, and so did Uber Eats.
Uber Eats, yeah.
So the mental model that I had in my head was Grubhub is the top dog, first mover, and has a network effect in its place, proved to be 100% false. I was wrong with my analysis. So when I learned that, I did some deeper thinking, was like, okay, I had a mental model in my head that the network effect was protecting this business at a national scale. That was incorrect. It turns out that for the food delivery market, the network effect matters at the city level, right? If you're ordering food in New York City or in Dallas, Texas, or in San Francisco, you're going to be going with the top dog and first mover in that market, not necessarily at the national level. And that is, I think, one reason why DoorDash was able to come in and outcompete Grubhub. So that was an example of, okay, I made an investment based on a thesis. I lost money. I've updated my thinking. How can I share this lesson with others investors? So I try and create visuals that help to clarify that lesson. I try to create videos that kind of explain that lesson. When we do live streams, that's the kind of nuance that we get into when we're talking about a business that's defended by a network effect. So all the graphics that you see me make, all the visuals that you see me make, they're based on mistakes that I've made in the past and things that I wish that I could explain to my former self.
I love that. I love that. We talked a lot of companies here, and in my eyes, there's several buckets you could put companies into. But of the companies that you probably want to be actually holding, you're going to have average, good, great. I think that's kind of the buckets there. What separates those for you? Kind of like define them.
Sure. Average business would be, by and large, the median company in the S&P 500. This is why, if you don't want to do this level of analysis, the standard advice of buy an index fund like the S&P 500 index fund or the total stock market index fund works just fine. An average business, if you buy all the businesses together, you get the great ones, you'll get the terrible ones, and they will average out to be roughly average business, and you'll get the average return of the stock market of 10% per year. Good businesses tend to have some attributes in them that make them better than the average businesses. So I would call these businesses in the top, say, 60 to 90% of all businesses out there. Maybe they have a more diversified customer base. Maybe they have a better management team. Maybe they offer better products and services. Maybe they have better execution. They do something that makes them a better business than, quote unquote, the average business on the market. Great businesses are in that rare top 3% of all businesses out there that have exceptional characteristics to them that provide far higher returns than the market does in general. They blow away all other businesses. These are extremely rare companies, and perhaps they have a far wider moat than the average business. Maybe they have way higher profit margins. Maybe they're on a monopoly or duopoly competitive position, right? Take a company like Google. Google has 90-ish% market share in the global search market. Everybody else fights for that remaining 10%.
Yeah,
that's exceptional. That's not good. That's not even great. That is exceptional market dominance of an incredibly lucrative market. The same could be said of Facebook, which has dominant market share in social networks around the globe in any market that it competes in. We can list off from memory probably the top 50 businesses of all time, many of which are popular companies that
Right.
most investors could know. So my goal as an investor is to fill my portfolio with those rare, great, exceptional businesses and avoid the average and good ones.
You said another word in there that I'm a big fan of when it comes to this type of investing, which is moat. And I think to me, like, moat is almost everything in a lot of areas. And so, we use Tesla as an example here. So Tesla, when you go back 6-7 years, the common phrase was there's no, moat to them building these electric vehicles. The large car makers, when they want to, they'll turn on the switch, they'll start making electric vehicles, and they'll be fine. Well, Ford this past week took a, I don't know, $19 billion write-off and said, hey, we're done. We're not making the F-150 in electric anymore. And so there was something that Tesla had there, which was moat, right? In other areas, and you thought that, like you mentioned, like there was a moat with Grubhub, but it turns out that they had other areas to get in. And so I think it's really difficult to find companies that have true moat. And so I'd really like to understand how you look at it, and if there's different levels of moat, if there's like impermeable versus, pretty good, just kind of like the depths of how you think about it.
Yeah. So to your point, it's one of the most important aspects to look at if you're a fundamental investor and you plan on owning a business for years. A moat is some attribute that is unique to the company that protects its revenue, profits, and customers from the forces of capitalism. There's lots of different sources of a company's moat. I'll tick through some of them. So there's network effect, which is when every new user makes the platform more valuable for all existing users. eBay benefited from this moat. Meta benefits from this moat. Marketplace businesses benefit from this kind of moat. Another moat is switching costs. When you, the user, experience pain in some way for switching away from a service. So as an example, I haven't changed banks in 25 years, not because there aren't better banks out there, but because the time and effort needed for me to undo all my financial entanglements with my bank to switch over, the cost to me as a consumer, even if it's not in dollars, it's in terms of time, isn't worth going through the pain and agitation of switching.
I think AWS is a big one there as well.
Absolutely. AWS has switching costs. Adobe has switching costs. Anytime you put a lot of time and effort into learning a software or how to use a medical device, there are huge switching costs to going to an alternative provider. Another one is low-cost production, where the business has such immense scale or buying power that it can buy things at a lower internal cost and pass those costs on to the consumers. So Costco is a great example of this. Good luck competing against Costco on price in the market, because Costco has such immense buying power. It can basically only compete. The only companies that can compete with it are like Amazon and Walmart. Essentially, and that's just about it. Another one is brand. So sometimes consumers are willing to pay a premium to get a certain brand name own them. Apple is a great example. LVMH is a great example. Lululemon was a great example. I don't know if it's such a great example anymore. But the final one is called counter positioning. This is when a company creates a new business model that the incumbents in that industry cannot match because it would cost them revenue. The easiest way to visualize this is Netflix versus Blockbuster. Netflix and Blockbuster sold the exact same thing, movies. There's no difference between a movie from Netflix and a movie from Blockbuster. Netflix initially changed its business model so that you paid a monthly fee and the DVDs came to you in the mail, and there was no late fees on them. Versus Blockbuster, you had to drive to the store. Same product, different business models. For Blockbuster to match Netflix's business model, it would have had to given up revenue. It would have had to say, our biggest advantage, these stores are now not an advantage for us. That's incredibly hard for a management team to do. They have to blow up their business and start over. No management team wants to do that. That is what I would argue is the moat that Tesla had in the first 10 years of its life. It did not want to use dealership models. It sold a car, a different type of car, in a unique way. I bought my Tesla on the internet. I didn't go into a dealership. I didn't talk to a salesperson. I put my credit card information and clicked buy, and then I went and just picked it up. So Tesla did not have to go through a dealer network. For Ford, GM, Volkswagen, Toyota, they can't do that. There's actually laws preventing them from doing that on the books. So Tesla had a unique way of selling a different type of vehicle, electric vehicles. So that's something that you really couldn't see, especially if you were skeptical of Tesla for many years, and you would think, how can it compete with Ford? How can it compete with GM? Me, the investor, thought the exact opposite. I thought, how can Ford compete with Tesla? How can GM compete with Tesla? I didn't see a way that they could do it over the long term, which is why I've been a Tesla shareholder for 13 years now.
Wow. Still holding. That's
Still
crazy.
holding.
So you bought back in 2012?
Yep.
Have you trimmed it all on this
Yes.
position?
Yep. I've
Okay,
actually trimmed to buy a Tesla, so that worked out fairly well.
that's fair. That's fair. I want to circle back. I want to dig deeper on this, but I want to circle back for a second to this idea of revenue versus profitability and how investors should think about that. And you pointed out correctly that it is about the stage that the company is in, but does it go a little further than that for you when you're kind of taking in those two numbers?
Yeah, of course. So revenue is something that companies that are early stages are hyper focused on, and that's the metric that investors judge them on. What a company is trying to prove when it's in the infancy stage or in the early development phase is that we have created a product or service that customers want to buy. That's what the company is focusing on. So it's deploying all resources into engineering, into research and development, into sales and marketing to raise awareness and raise sales at the business. That is the right thing to do at that stage. They're not focused on profit at all. As a business matures and starts to penetrate more and more of its market, the business grows to enough of a big size when it can start to focus on profitability. It no longer wants to be losing money. It wants to actually be a self-funding organization. And management starts to control expenses while trying to increase the sales at a rate. And
Right.
then the question you have to ask as an investor is, what are the margins of the business? Or in other words, for every dollar in sales, how many pennies can the company turn into profit? In an ideal world, that number increases over time. And if you listen to the academics, an academic will say, what's the value of a business? It's all the cash inflows and outflow of that business over its entire lifetime. And that might academically be true. But the ultimate goal for any business that's creating revenue is to turn that revenue into cash flow that the company can use to reward investors. That's what all companies are trying to do. So again, which number you're paying attention to, revenue or profits/cash flow, depends heavily on what stage of the business the company is in.
That definitely makes sense. And then one other piece within the fundamental analysis that I don't think we've touched a lot on, even though we've mentioned companies like Tesla and others, is leadership and management.
Okay.
And that's something where it's a little bit less quantifiable, right? I'm curious how you go about examining leadership and management. Is it looking at track record and history? Is it what they've done with the company that they're in so far? Are there other pieces to it?
Yep. So management matters enormously the earlier the business is. So if a company is trying to, again, it's in stage 1 or stage 2, it's in the hypergrowth phase, management has a massive challenge on their hand. They're trying to scale up the operations. They're trying to hire an executive team. They're trying to use R&D dollars to effectively make a product or service, and they're trying to penetrate or take share or grow an existing market. That is an enormous challenge. And the founders out there or the early executives that join a company, it's a very high risk situation for them, and it's extremely challenging to do that. So leadership matters hugely early on. The way that you, as an outside investor, can judge whether or not they're doing a good job or whether they're a good bet is things that you just said. What is their track record? How long have they been in the industry for? These are actually things that you can look up easily. Another thing to look up. How much skin in the game do they have? How much of the stock do they personally own? Will they become a multi-hundred millionaire or a billionaire if they can execute? And if the stock goes down, will they be hurt financially far more than I am as an investor? These things matter. The other thing that matters is how are they with managing Wall Street's expectations, especially if they're publicly traded? Do they have a history of exceeding their revenue guidance consistently? That to me is a great sign if a management team consistently exceeds its revenue targets, the old beat and raise. Some people say, that doesn't matter. To me, it matters tremendously. That is execution. The point of management is doing a good job when they can execute, and they're doing a bad job if they can't. Period. Full stop. End of story. That is their report card that you are judging them by. The other thing that you can do is, as a company scales, you can check things like, do employees like working here? Is this place attracting the best and the brightest? You can go to Glassdoor, Indeed, Comparably, LinkedIn, and just see, do employees give this CEO and this company good approval ratings? Now, the later stage companies, stage 5 companies, for example, leadership still matters, but it matters less. You could make me, a wholly unqualified person, the CEO of Coca-Cola, and I'm sure the financial statements of the business won't change all that much because the company is so well established. Its product lines are there. The only thing I would have to do is not screw things up. Just go in there and not screw things up. there is probably one person in the world that's qualified to run Tesla. And that is Elon Musk. That is such a complicated business, and capital allocation matters a great deal. Engineering matters a great deal. So leadership at Tesla matters far more than I would say leadership does at some traditional, big, stodgy, slow-moving businesses.
It's funny, now that you say it, I'm not sure I know who the CEO of Coca-Cola is off the top of my head.
There you go. And the way that you can judge, are they doing a good job or not, is what's their policy on the dividend? Are they continuing to grow at case volumes at some low or meaningful number? But yeah, those are cushy, great jobs where it's really hard. It's really hard to screw that company up.
Right.
Whereas, so the onus isn't on the management teams of those kind of companies to be exceptional. It's don't be terrible. Whereas a company like Tesla or early stage companies, the onus on management is to really be exceptional.
With all that being said, do you have a few favorite CEOs that you think embody a lot of those traits?
Yeah, I mean, the ones that come to mind are all the ones that are famous out there. I've personally been a massive fan of Mark Zuckerberg for years, and his is somebody who's like stock in the public markets has gone up and down based along things like what's he done to society, what's Instagram doing to this or that. I think he is an exceptional leader. I think he has exceptional foresight. I love that he makes big bets, even the Reality Labs things that he does that clearly has not worked out. But he was at least willing to go out there and make a big, massive bet on an opportunity that he saw, which is very hard for other people to do, especially since he was effectively causing his stock to fall 70, 80%. And that was because of a decision that he made, and he's since come out and kind of reversed that decision. But he went out there and bet big on Instagram before nobody saw the value in that. He bet big on WhatsApp. That's still a question in the air. He's rolled out Threads, which I thought was going to be dead on arrival. It turns out that that's actually a viable product and a decent competitor to X. So Mark Zuckerberg is someone that I hold in top regards. Another one that's lesser known is I'm gonna butcher his name, but it's Shantaran Narayan. He's the CEO of Adobe. Adobe has been an exceptional performer under his leadership. He's been a very long-term employee at the company. He gets glowing ratings on Glassdoor. He's transformed the business from a one-time purchase perpetual license model to a software as a service business. The business is growing at double digits, and now he has this huge challenge to take on about the market perception about how AI is going to steamroll Adobe stock, and that's why the stock is down very much. But from a actual business metric performance, from a leadership perspective, and for what the business has actually done, I think he's an unsung tech hero.
Very interesting. Yeah, I like hearing about some of these guys who maybe aren't, talked about on Fin, Twitter, YouTube all the time, but really are pulling hard for their companies. So we talked about all of the things to look for. I want to talk about some of the mistakes, the red flags, the things that you see people doing. Like, what are those common things that retail investors just continuously make mistakes when it comes to fundamental investing?
Yep. So if I was starting investing today, if I was a brand new retail investor, I would be doing exact same things that I see people have done over the last 5 years. I would be on Reddit. I would have been day trading GameStop and AMC. I would have been following the price action of crypto currencies and all that kind of stuff. So when I look at that as a more experienced investor, I see that kind of activity happening. I say, well, that is just me 20 years ago, doing the exact same thing that those people are doing today. The biggest mistake that I see that people make, that investors make, is they don't know what they want from the investment before they make it. Like if you're going to be going out there and you're going to be buying, let's just say you got caught up in the GameStop phrase and you purchased GameStop. What were you looking for? What was your goal with that investment? I have a strong feeling that many people thought, I want this stock to go up 10% tomorrow.
Yeah.
And fair enough if that's what you think that you want from an investment, but that's not investing. That is day trading, and in my view, that is more akin to gambling than it is to investing. Many people don't know the fundamentals of the stocks that they are buying. They're buying them because they see them trending on Reddit, see them trending on CNBC, or maybe they hear that their friend made a bunch of money in it. If that's what you're doing, have at it, right? It's your money on the line, but I don't view that as investing. I view that as gambling. To me, investing is finding a good business, buying it on the basis that you believe that 3, 5, 10 years from now, or whatever your intended holding period is, that you believe that that company has a high likelihood of making you the return that you are looking for while assuming the risk that you want to take on. I don't think that many people that are buying stocks consider the return that they want or the risk that they're taking on, or why that company is the right choice for them based on in comparison to all the other investments that are out there. Investing is a massive mind game, and everybody that's listening to this was born a bad investor. Every instinct that you have that makes you well adapted to society makes you a bad investor, and it's up to you to train yourself to fight those urges, and that's what makes for actual good investing.
Yeah, we did a pod years ago, and that was the one big thing that I took away from it, was you basically saying, like, human nature makes us bad investors. You have to basically fight it. Can you talk a little bit more on that?
Oh yeah. What do we want to do? What makes us want to capable of surviving in society over long periods of time? We naturally take cues from those that are around us. If people around us are excited and buying a stock and saying, and they've made money, we naturally want to rush into that thing because we have all this social pressure around us saying this is a good idea. Conversely, if people are out there saying this company is horrible and you see the stock going down, you don't want to touch that thing. You think that is toxic. You're taking your cues from other people, which helps us survive socially in the real world. But that is exactly the opposite of what you need to do to invest well. Everyone knows the phrase, buy low, sell high. Well, that's a very easy thing to say. It's a very hard thing to do. When was the best time to buy stocks in the last, let's call it 5 years? It was after the COVID drop, so March of 2020, and then after the massive plunge in 2022. So let's call that January of 2023. Did anybody feel like buying stocks during those periods after stocks just nosedived, after all these formerly high-flying stocks had fallen hugely, or especially during the rips of COVID when people are like, is the world ending? Will we be able to go outside again? Is the death toll going to skyrocket and all these prices are going down? No. Nobody wants to buy stocks when they're cheap because your mind is naturally filled with fear. So it's really hard to overcome the biological programming that you have in you to actually make good investing decisions.
Yeah, that right there is what separates people. So last thing I just want to touch on real quick is conviction, because I think that this is what separates people, right? Because you can have somebody that does all the work. They research the company, they research the CEO, the moat, the revenue, the operating profit, and they come and they say, this is a great company. And then they put $1,000 in, right? And it just doesn't create any real change in their lives long term. And you need that conviction that says, okay, well, I'm going to take a $100,000 position, a $50,000 position. Like, how do you, talk to people and advise them to build conviction?
Yeah, so conviction is essential before you make any investment, because your stamina, your ability to hold that stock, if you hold it long enough, I guarantee you it will be tested. Look at the 70-year history of Berkshire Hathaway. Does it get any bigger, more predictable, more reliable, more well managed than Berkshire Hathaway? No, it's phenomenal long-term investment. But top tick to bottom tick, that stock fell 50% more than 4 times over its history, including a 50% drop during the height of the speculation in 1999. So NASDAQ all-time high, Berkshire all-time low.
Wow.
How would you have the conviction to hold on to that stock when the market is going up and your stock is going down? You have to know that company inside and out, and you have to have a deep internal belief about the long-term viability of that company, and it will be tested. The only way that you can survive the volatility that is guaranteed to hit any stock that you own is by having the internal conviction that you know that company well enough and you believe in that company's long-term future. I've been a Netflix shareholder for 16 years now. I think peak to trough, that stock's fallen 80% twice since that I've held it. People might not even remember the Quickster thing that happened 13 years ago at this point, or even more recently when before they switched to the ad-supported market. In both those times, my position in Netflix got pounded, and there were people screaming, Netflix is done, Netflix is dead. I continued to hold through both of those periods, which sucked, which were absolutely painful, but Netflix has recently hit an all-time high. So in both cases, holding or buying more was the correct long thing to do, even though the short-term pain for holding Netflix was immense. The only reason I could do that is because I knew the company well, I knew the management team well, and I believed in the business long-term.
Yeah, I actually love that example. I gave a presentation at the Money Show on building conviction, and that was my example, was the Netflix with the piece.
It's a great example, and it's not even been the most volatile stock that I've held.
Yeah, a ton of great lessons in here. Honestly, I could pick your brain for forever, but we don't have the time for that. But luckily for the audience, you have put out hundreds, if not tens of thousands of hours of content that they can go consume. I really encourage people, if you're thinking everything that Brian said, about, hey, these are the metrics you need to look at. He's created a spreadsheet for that. He has an ebook for that, right? If you're thinking about, Tesla, Netflix, others, like you have videos on them as breakdowns as well. So just where's the best place for everyone to find your content?
Yep. So whatever platform you're listening to that, I'm likely on this. But we put a ton of effort and time into our YouTube channel, which is called Long-Term Mindset. We do weekly live streams and breakdowns. I do videos on book reviews, breakdown super investors, accounting lessons, and more. So that's probably the best place if you want to consume video content.
Perfect. And then I think one thing which we also didn't touch on is, I guess with Grubhub, like you talk about it, sometimes it's like the key between knowing like, hey, I'm going to hold this long term, and hey, being able to say I was wrong. And I think that you enunciated those differences really, really well for the long-term investor and all the pieces in between. So I hope you'll come out of this and just think about building conviction and also giving yourself a time frame to actually be able to hold something long-term and allow it to blossom. A great company certainly is not born in a day, a week, or a year, or even sometimes 5 or 10 years. Your decade plus long holdings have really shown that. Brian, thank you so much for the education. I've been in the investing world for about a decade, and I come out of these conversations with you feeling ready to go, motivated, excited to dig into companies. So I can only imagine for the audience. Thank you so much.
Thanks for having me, Gav. It's always fun to be here.
Love it. Everyone else tuning in, I hope you really enjoyed this episode. Please, if you did, go ahead and comment below. If you have any questions, I'll try to feed them back to Brian. We'll see what we can do. Subscribe to the channel. And that's been it for this Wolf Financial Podcast. Take care, everybody. We'll see you on the next one.